Hello friends, in this video I'm going to talk about basics of futures. So futures in trading, there are so many words: expiry, obligation, derivative. All these are so confusing and we have to think about our future. Let's see what are futures. Okay, futures are financial products that investors can use to hedge current investments or trade them for making money. Let's see the definition. It's an obligation to buy or sell an underlying stock or asset at predetermined price and deliverable at predetermined time. So the definition is little confusing. So futures are derivatives, means their value depends on other assets like index, stocks, physical commodities. So let's talk about future trading with respect to the real world. When we transact a future, meaning the buyer must purchase or seller must sell the underlying asset at the set price regardless of the current market price at expiration date. So this expiry date is more important. Little confusing again. So let's take an example. Usual example you must have read is the corn example. Say a farmer is growing some vegetable. He can enter into an agreement, future agreement, okay, for 3 months from the current date to sell his veggies at say rupees 30 per kg. So that rupees 30 per kg, keeping in the mind about his investments and other things. So he may have speculated that veggies price may go down after 3 months. So here expiry is the third month, some date, whatever. So on that day, if veggies price is below 30 rupees, say 15 rupees, okay. So 30 rupees is the predetermined price and predetermined date is the third month of some date. So even if the veggie is rupees 15, he still gets a chance to sell his veggies at rupees 30 per kg because he had locked that price 3 months back. Okay, that's the predetermined price. But if veggies price on that day is 40 rupees, he still has to sell veggies at 30 rupees only. He will not be getting that extra 10 rupees profit. Okay, this is with respect to the definition. And we also talked about hedging in the definition. So hedging means, say, if there are unfavorable movements in the assets, the stocks which we are holding, so to prevent the losses, one can hedge in futures. So for example, one has bought Infi shares at some value, okay. So there may be some news expected or the person may speculate to incur losses in future but don't want to exit the position. Now what he can do is he can go and sell the Infi futures. So futures work on leverage. Leverage means you don't have to pay full amount. We will see what is it. Here one future lot of Infi is equal to 600 shares. One has to buy one lot. There will be no half lot or quarter lot. And Infi is trading at 1370 rupees per share. So you need a margin amount of 88,503 rupees for one lot of future of Infi, which will be blocked till you hold the position, whatever you make profit or loss. But actually, if you want to transact 600 Infi shares, you have to pay around 8 lakh, okay, 8 lakh 22,000. So here, if share price is going down, in case if we have entered into futures trading, if share price is going down, we'll be getting profit in the future because we have gone short in the future. But we have used less money margin, okay. Yeah. Okay, this is about hedging. Now let's see the identity of future. So their identity is like underlying name and expiry period. See, for example, you can see for Infi future I have typed. So it is showing 3 futures. Okay, Infi April future, May future, and June future. See, April future is the current month future, and May future month, May future and June future, they are near and far futures. So one should always try to trade in the current month future because they are more liquid compared to near and far month futures. See here you can see I have shown the example of Nifty futures, which is the April month future has volume, more volume compared to the other 2 months future. Now we will see different types of futures. So they are commodity futures. Commodities like crude oil, natural gas, and corn, potato, precious metals like silver, gold, platinum, base metals, copper, nickel, lead. So these are all the commodity futures. And index futures like Nifty, Bank Nifty, Fin Nifty, etc. Then currency futures like USD, INR, other currencies. And we have stock futures also like Infosys, Reliance, and very good liquid companies have future trading. And trading futures, this is more important. So one can speculate using their own strategy. Speculate means whether the price will go up or down, okay, using their own strategy and trade on futures. But always remember to trade with stop loss and also understand the risks involved in futures. And so we'll be using the margin amount, right? Sometimes margin amount may increase for the future which we are holding, okay, and we will be getting the intimation in case if the margin is more and we may have to pay it, or there will be some settlement regarding the same. So, and one more important thing is usually most of the people don't hold futures till expiry. So one can always exit before expiry. Any date you can do intraday also. So within the same day enter into, and even the margin amount will be less for intraday future trading. So one can exit before expiry and he is free from that obligation or agreement. Or if you hold till expiry, and some are usually, most of them are cash settled, and are very few maybe, you may have to take the possession of underlying physical derivatives which aren't encouraged, and most of the people they don't want to take, right? So it may be like we saw in our example, the former example, maybe the producers or companies can take it to keep the cost of raw materials at fixed level. So these futures are very easy to understand and have greater margin use and are often liquid, but are complex compared to underlying assets or stocks, okay. And when we see these options, they're even more complex than futures. We will be discussing about options in our forthcoming videos, okay. And the final thing is always understand all the risks involved in future trading before entering into the future trading. Thank you.